Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now the Fed had a difficult job this week, with Chair Powell clearly seeking to balance a resurgence in inflation concerns on one hand against some signs of slowing growth. The question now, of course, is whether markets have priced these concerns or whether recent volatility has further to go. Equally important during times of volatility, of course, is to identify whether some interesting investment opportunities have been created. So, to discuss these questions and more, I'm pleased to have today on the podcast Rajat Bhattacharya, who's a senior investment strategist in the CIO office. So, welcome, Rajat. Thanks for taking the time to join us today. The Fed, it appears to be at pains to balance, bringing inflation under control, but emphasizing that rate hikes were not under consideration. What's your read of the broader U.S. macro picture at this point in time?
Hi, Manpreet. Glad to be here. The US macroeconomic data, I must say, remains inconclusive. So, on the negative side, inflation is rising, the job market is slowing, and the manufacturing sector is contracting again. However, US corporate earnings have beaten expectations yet again in the first quarter. So let's discuss the macro drivers one at a time. I mentioned US inflation, and this has been on an uptrend since the start of the year. A 1.1% quarter on quarter upturn, so which means almost more than 4% upturn in the first quarter in the employment cost index, which is a key measure of US wage growth, mirrored an ongoing rebound in the Fed's core inflation gauge, which is the core PCE inflation, as well as in the prices paid components of the business confidence indices. At the same time, the US job market continues to slow. And we know that because we've seen the sustained downtrend in the job vacancy rate, which comes out separately in terms of the job openings data, and which the job vacancy rate actually fell to a 3-year low in March. So we should look out for, of course, the payrolls data tonight, where the consensus is expecting a slowdown in the job creation. Now, I mentioned the manufacturing sector as well. The U.S. manufacturing sector, including the new orders and new export orders components, have returned to contraction in April, based on the latest ISM manufacturing PMI data. So all of this shows that the data so far is turning towards further slowdown in the economy.
That's interesting. And I think thanks for that overview. But what does all of that mean for the Fed? I mean, how exactly do you see their policy measures playing out amidst all the conflicting set of data that you just described?
So the Fed is in a real dilemma. I say that because having turned dovish late last year, which is the Fed, it now seems that dovish turn was premature, and it has now got to deal with this resurgence in inflation. Now it expects growth to slow in the coming quarters as two-decade high interest rates impact the economy, helping cool the job market and lower inflation later. This explains why Fed Chair Powell, after keeping rates steady at this week's policy meeting, reiterated that the base case for the Fed is more likely that the Fed is more likely to cut rates later this year than hike rates. Now, we broadly agree with this macroeconomic outlook. The rise in corporate bankruptcies and credit card and auto delinquencies indicate weaker parts of the economy are hurting from higher rates. The slowing job vacancy rate, as I mentioned earlier, and the quits rate are leading indicators for wage growth. A burst of immigration over the past year is helping ease labor shortages. This, in turn, is sustaining the US job market and consumption even as household excess savings dwindle. The new entrance to the job market should also help ease wage pressures, thus enabling the Fed to cut rates later this year. However, I must warn that managing this soft landing will take deft management of monetary policy and is likely to be challenging. This is why probably market volatility is going to rise in the coming months.
Okay, so against the backdrop you just described, one argument being made in markets, of course, is that of a likely rotation away from US equities towards Asia Japan equities. In your view, does that mean that the rally we're currently experiencing in Chinese equities has room to extend?
Indeed, we do think that there might be some further upturn here. Global markets are starting to see a rotation of flows away from the US and into Asia, partly amid the concerns that we just highlighted about high US valuations and the rising inflation in the US. Now, global and US stocks have pared back about 3 to 4% from the record highs. Meanwhile, Hong Kong's Hang Seng Index has now just entered a bull market. So, what's going on here? So, Chinese equities have been benefiting, for instance, from this regional rotation that I've talked about. Rising concerns about US inflation and the room it leaves for the Fed to cut rates likely imply potential increase in US equity volatility in the near term. Against these macro uncertainties, we think Chinese equities are currently kind of a safe haven, if you will, because the bad news in China has been well publicized and arguably priced in. Chinese equities continue to trade at a heavy valuation discount of as much as 45% in the offshore market, whereas the onshore Chinese equities are trading at almost a 27% discount relative to global equities. Investor positioning is also light. The rally has been broadening out from the high dividend paying state owned enterprises sector to the higher beta, higher volatility internet and technology stocks. We expect the Hang Seng Index to consolidate in the near term due to its strong rebound so far. And however, as it approaches, it has a resistance at around 18,840. We believe once it pulls back, there's an attractive opportunity to accumulate between the levels of 17,300 to 17,800, especially if the US macro uncertainties persist.
All right, well, staying in Asia for a moment, the other big story there, of course, has been the volatile Japanese yen. What's your view on dollar yen, and what do you expect the impact to be on Japanese equities?
Yes, the yen has been facing downward pressure all through April amid the hawkish US inflation data, which resulted in US yields and the dollar surging. Meanwhile, BOJ just left rates unchanged and offered no indication that it was in a hurry to halt the currency pair's rise, so the dollar yen's rise, that is, with higher borrowing costs, and arguably so because we just saw Tokyo inflation underwhelm. It actually is on a downtrend. So there's no reason really for the BOJ to hike rates at this moment. Although likely policy intervention over the past week helped the dollar yen avoid a break above 160, the risk remains tilted towards further upside in the short term. Our 3 month view on the dollar yen pair is around 156. So, given this still strong dollar and the patient BOJ, the real rate differential between the US and Japan still favors the dollar in our view. For now, markets continue to expect Fed to cut rates in the second half for a total of around 35 basis points by the year end. So we see the dollar yen pair retreating to around 150 in this scenario. This scenario means if the Fed does cut rates, which is our base case. However, if the Fed postpones easing rates to 2025 amid a stickier inflation, then dollar yen could surge towards 165, 166. Now, the yen weakness is favorable for Japanese equities as it supports the earnings outlook for exporters through greater competitiveness relative to other Asian exporters. However, we must, of course, realize that one risk we should keep a watch on is whether the scenario of extended yen weakness raises expectations of similar weakness in other Asian currencies.
All right, and finally, maybe just returning to the US very quickly. We're well into US earnings season. What's your read of the positive surprises we've been getting so far?
Yes, the US earnings have once again beaten expectations, as I mentioned earlier. A total of about 75% of the companies, so three-fourths of the companies in the S&P 500 have reported so far, and of them, four-fifth, four out of five companies have beaten expectations according to the latest numbers. So this is better than the historical average of around 66% of companies beating expectations. The earnings surprise has been broad, with all sectors delivering a positive earnings surprise. The first quarter earnings are now expected to grow by around 7%, up from around 5% at the start of April. More positively, the 2024 and 2025 full year earnings estimates have now been revised up as well. The sectors with the greatest percentage point improvement in 2024 growth are communication services and energy. This ties in with our preferred view on these two sectors. Communication services is seeing strong growth momentum in digital advertising, while the oil price gains this year are paring back expectations for a decline in energy sector earnings. In terms of the Magnificent Seven stocks, six of those seven stocks have reported so far with a combined 37% year on year earnings growth and almost 9% earnings surprise, although the guidance has been mixed. This is in line with the overall market's 9% earnings surprise in the S&P 500 so far. So US equities are consolidating in the near term, but we believe these strong earnings are going to continue and, in fact, broaden out across the sectors. And this is likely to drive their outperformance over the next 6 to 12 months.
Okay, well, thanks very much, Rajat. I think we're just about out of time, so we'll end it there. Thanks, as always, for taking time to join us today. If I can again summarize the main takeaways from today's conversation, first off, in the near term, we do see Chinese equities as likely to be a key beneficiary of the rotation towards Asia-Japan equities. Second, Japanese equities potentially could do well in a scenario where downward pressure on the yen persists. And third, notwithstanding the risk of near-term volatility, US earnings outlook so far does support our overweight on US equities. So, with that, we'll bring today's podcast to a close. Thank you, as always, for taking time to listen in. We hope you enjoyed today's podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.